Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of all the jargon and numbers that companies put out there. In this video, we are going to break down Star Group's latest annual report for their 2025 fiscal year. And let me tell you, it's packed with numbers that tell a pretty wild story about how this energy company is navigating some interesting times. Make sure you are subscribed because we are diving deep into the financials that really matter. And if you want to chat more about this or any other filings, join our Discord community linked in the description below. Alright, let's get into it. Star Group LP is a big player in home heating oil and propane distribution, mostly in the Northeast and Mid-Atlantic. They have a lot of operations and keeping track of everything is crucial. This report covers their fiscal year ending the 30th of September 2025. Before we jump into the numbers, like most companies, they are putting a lot of forward-looking statements in here. These are their best guesses about the future, including how things like gas prices, weather, and even global events might affect them. They are also warning that actual results could be quite different, which you should always keep in mind. So, what's the core business? They sell heating oil and propane to about 406,000 full-service customers, and another 63,000 delivery-only customers. Imagine that many people relying on them for heat. They also sell gasoline and diesel fuel to about 27,700 customers. A big part of their strategy is also installing and servicing heating and air conditioning equipment, which helps them keep customers loyal and brings in extra money. They're saying they are the largest retail distributor of home heating oil in the United States, which is a pretty bold claim. Now, every company has risks and Star Group is no different. They are heavily exposed to the volatility of wholesale product costs. If oil and propane prices shoot up, it directly impacts their profit margins. They have to be careful about how much they can pass on to customers because customers can get conservation or even switch to a competitor. This is a huge concern for them. Also, supply chain disruptions are a big worry, from weather events to global conflicts, all of which can make it hard to get enough product to their customers. And let's not forget about the increasing regulations around greenhouse gas emissions. States like New York are pushing for cleaner energy, and that could mean less demand for their traditional products in the future. They are also very clear about needing to acquire other businesses to grow, which always comes with its own set of risks. Okay, let's talk about their stock. Their common units, SGU, are traded on the New York Stock Exchange. This section gives us a peek at the unit prices. In 2025, the high for their common unit price was around $13.75 and the low was around $10.84. Compare that to 2024, where the high was $14.76 and the low was $9.64. It shows some fluctuation, which is pretty standard. What is more interesting is how much cash they are distributing. In 2025, they declared distributions of $0.74 per unit annually, up from $0.67 in 2024. This is a key metric for investors in these types of companies. This is where the company really breaks down their performance, and it is crucial for understanding what is driving their numbers. First off, let's look at volume. Their home heating oil and propane sales increased by a solid 11.5% in 2025, reaching 282.6 million gallons. This is a good sign. They attribute part of this to colder weather in 2025 compared to 2024, which makes sense for their business. Acquisitions also played a big role, adding a significant chunk of volume. On the flip side, sales of motor fuel and other petroleum products actually decreased by about 4% to 123.9 million gallons. When we look at the money coming in from selling these products, total product sales for 2025 were $1.437 billion. That's a tiny bit lower, or 0.8%, than in 2024. Even though they sold more gallons, the average selling price per gallon went down. This is mainly because the wholesale cost of these products also decreased. But here is where things get interesting. Sales from their installations and services arm really grew, going up 9.3% to $346.8 million. This segment is becoming increasingly important, likely driven by new acquisitions and a focus on offering more to their existing customer base. This is exactly the kind of diversification that can help a company like Star Group weather the storms of volatile fuel prices. On the cost side, the cost of the products they sell went down by 7% to $912.4 million. This is directly related to that decrease in wholesale product costs we saw. Now, for the juicy part, gross profit for product sales was $525.2 million, a nice increase of 12.2% compared to 2024. They highlight that home heating oil and propane margins increased by about 1.3% per gallon. This is important because they believe evaluating margins on a cents per gallon basis. before accounting for the ups and downs of their hedging instruments, gives a clearer picture of the underlying business health. Their delivery and branch expenses went up by $34.4 million. A chunk of this is due to that weather hedge contract I mentioned earlier. In 2025, the weather was colder than their hedge anticipated, which meant they had to pay out more, leading to an expense related to those contracts. Acquisitions also added to these costs as expected. Interest expense went up by almost 24%. This is mainly because they had higher average borrowings, meaning they owe more money. Even though the interest rates themselves were a bit lower, the sheer amount they borrowed meant higher interest payments. They are using interest rate swaps to try and manage this risk. So summing it all up, their net income for 2025 shot up by over 108% to $73.5 million. This jump is thanks to a combination of factors: a big favourable change in the value of their derivative instruments, that strong performance in installations and services, and a gain from selling a property. On the other hand, they had higher taxes, increased depreciation, and those higher interest expenses. They also give us adjusted EBITDA, which is a key measure for them in assessing operational performance. It increased by a healthy 22.2% to $136.4 million. This gain was driven by improvements in their core business, including better per gallon margins in heating oil and propane, higher volumes due to colder weather, and strong performance in installations and services. This really shows they are tightening up their operations and expanding in profitable areas. Looking at cash flow, cash from operations decreased by about $40 million. This is largely due to an increase in their accounts receivable, meaning customers owed them more money at the end of the year. With more sales, especially from acquisitions and colder weather, it is natural for this to go up, but it does tie up more cash. They also had increased cash usage for inventory purchases as they prepared for the current heating season. In investments, their capital expenditures were around $14.9 million, mainly for their truck fleet, equipment upgrades, and expanding their propane business. They also spent a hefty sum on acquisitions, around $88.1 million in 2025, adding more businesses and customers to their portfolio. On the financing front, they repaid $21 million of their term loan. They also repurchased about 1.3 million common units, spending $15.6 million on their unit repurchase plan. This is a way for them to return value to shareholders. Distributions to common unit holders and the general partner also totaled over $26 million for 2025. Let's hop over to the balance sheet. This shows what they own and what they owe. Their total current liabilities, or what they owe in the short term, went down slightly to $349.2 million. This is quite a bit, but it includes accounts payable, revolving credit facility borrowings, though none were outstanding at the end of 2025, and current portions of their long-term debt and leases. Their long-term debt sits at $167.1 million for 2025, down from $187.8 million in 2024, which is a positive sign of them reducing their debt load. Partners' capital, which essentially represents the owner's stake in the company, increased to $296.7 million from $263.8 million. This reflects their increased net income and reinvestment in the business. This table looks at their allowance for doubtful accounts. For 2025, they set aside $6.8 million for potential bad debts, bringing their total allowance to $7.1 million. This is up from $6.4 million in 2024. It indicates they might be seeing a slight uptick in the risk of customers not paying, perhaps due to economic conditions. This is a critical section detailing their debt. At the 30th of September 2025, they had $188.1 million outstanding in their senior secured term loan. Their credit agreement, which was refinanced in September 2024, gives them access to a $400 million revolving credit facility, which can go up to $475 million during peaking season. This facility matures in September 2029. They seem to be managing their debt well, with a significant amount of unused borrowing capacity. However, they do have strict financial covenants they must meet, including maintaining certain coverage ratios. They contribute to 401 plans for their employees, amounting to about $8.9 million in 2025. They also contribute to multi-employer pension plans due to their unionized workforce. Some of these plans are in a red zone, meaning they are not well funded, which could mean future contribution increases for Star Group. They also have a withdrawal liability of over $15 million for one of these pension plans, payable over 30 years. Looking at leadership, the report lists the key executives and directors. Paula Vermeulen Jr. is the chairman, Jeffrey M. Woosnam is the president and CEO. It is good to see a familiar face there, as he has been with the company for a while, holding various operational roles. This table shows what the top executives are getting paid. For 2025, CEO Jeffrey M. Woosnam's total compensation was about $1.4 million, including salary, profit sharing, and other benefits. The Chief Financial Officer, Richard F. Ambury, earned about $1.47 million. These numbers have increased year over year, generally in line with the company's performance, especially that significant jump in 2025 net income. They also provide a stark pay ratio comparison. Their CEO earns 18 times what their median employee earns. Here we see who owns the company. Kestrel Heat, the general partner, owns 100% of the general partner units. Among the common unit holders, the executives and directors as a group own about 12.29%. Major institutional investors like Hartree Partners and Bandera Partners also hold significant stakes. This section covers any dealings between the company and its executives or directors. The most notable one is a lease agreement for a property used in their Pennsylvania operations, where the lessor is entities connected to the father of their CEO, Jeffrey Woosnam. The lease has been amended and extended, with the current rent payments and terms appearing to be negotiated at arm's length, which is good to see. Other than this, there are no other significant related party transactions noted. Their auditor, KPMG, billed over $2.6 million for audit and tax services in 2025. It is standard practice for these firms to provide these services. Now we get to the detailed financial statements. Looking at the balance sheet as of the 30th of September 2025, they had cash and cash equivalents of about $24.7 million. This is noticeably lower than the $117.3 million they had in 2024, which could be tied to their acquisitions and increased operating activities. Their property and equipment net increased significantly, likely due to those acquisitions. The statement of operations shows their income and expenses over time. Total sales for 2025 were $1.784 billion, a slight increase from 2024, but remember, the installations and services part really drove that growth. Cost of product decreased, and importantly, they showed a significant gain from the change in fair value of derivative instruments, which was a loss in the previous year. This volatility in derivatives is something to watch. Cash flow from operations decreased to $71 million in 2025 from $111 million in 2024. Again, a chunk of this is due to that increase in accounts receivable. Investing activities show an outflow of nearly $100 million, heavily influenced by those acquisitions I mentioned. Financing activities show a net outflow as well, primarily due to debt repayments and unit repurchases. These notes are where all the nitty-gritty details are explained. We see they call themselves a single reportable segment, which means they operate as one whole business. They explain their accounting policies in detail, like how they recognize revenue, value inventory, and account for their business combinations. Their goodwill increased significantly, mainly due to those acquisitions. Goodwill is basically the premium paid over the fair value of acquired assets. This tells us acquisition is a key growth strategy for them. Here they detail their credit agreement. As of the 30th of September 2025, they had $189 million outstanding on their term loan and no borrowings on their revolving credit facility. This is a strong position to be in, with $165 million in availability. They are clearly focusing on managing their debt and operations to stay within their loan covenants, including important ratios like the senior secured leverage ratio. This shows their reserves for bad debts, which increased slightly, suggesting they might be anticipating a tougher collection period for some customers. They detail their contributions to multi-employer pension plans and the fact that some are underfunded. This is a long-term commitment and a potential future financial burden. One particular plan, the New England Teamsters and Trucking Industry Pension Fund, has a withdrawal obligation with a remaining balance of over $15 million, paid off over 30 years. So, what's the story here? Star Group is a solid company in a challenging but essential industry. They are successfully growing through acquisitions and diversifying their revenue streams with services and installations, which is a smart move given the long-term trend away from heating oil. However, they are still heavily exposed to market volatility in fuel prices and are grappling with increased regulatory pressures and potential customer attrition. Their cash flow from operations took a hit, largely due to increased accounts receivable from higher sales, which is something to monitor. On the debt front, they seem to be in a reasonably good spot with significant availability under their credit facility and a reduction in their term loan balance. Their leadership team appears experienced, and they are focused on retaining talent and managing risks, including cybersecurity. Overall, they are navigating a complex market by leaning into acquisitions and services while managing the inherent risks of the energy sector. It's a balancing act, and the coming years will show how well they can continue to adapt to changing energy landscapes. What do you think about Star Group's performance and their strategy moving forward? Let me know your thoughts in the comments below. If you found this breakdown helpful, Please hit that like button and definitely subscribe for more deep dives into corporate filings. And remember, you can join the conversation and connect with other finance enthusiasts on our Discord channel, linked in the description. Thanks for watching, and I'll see you in the next video.